Today in this video, I'm analyzing companies like IL&FS Engineering, IVRCL, IRB Infra, Jaypee Infra and IRCON. These companies are into construction of roads and other development projects. The results for these companies are up to date till March 2018 for the first three companies, and Jaypee and IRCON are up to date till June 2019. Even the financial year is up to date till March 2019. For IL&FS, IVR and IRB, the annual results are up to date only up till March 2018. This video is not for analyzing and giving scores or seeing which company is better. This is more of an educational video that I'm making. This is to understand which type of companies we should not put our money into. And even if we have already got invested or we are already invested in these kind of companies, what is the right time to exit? Even if there is a loss, whether it's a major loss or a minor loss, when should we exit? When is the time that we should not keep our money inside? No way we should leave the money inside the company. We should sell and exit, whatever the case may be. So there are certain situations or red flags we can say, or problems that is very apparent when we look at the ratios and the balance sheet and P&L account. It will become very apparent when and where at what point, even if you are invested, we should get out. And if you are not invested, what are the things that we should look for, that if it is there, then we should not be putting our money in those type of companies. With these infrastructure companies, it will become very apparent the problems that these companies are facing and what has happened to these companies. Let us look at the current market price and the face value. Most of these companies' face value is 10, except for IVRCL at a face value of 2. So we equalize it for 10, that is multiply 2 face value with 5, so it becomes 10, which is like equalized with all other group companies. So we get a price of approximately 2 rupees. So even in this case, the most expensive is IRCON and IRB Infra. Next, let us look at what is the percentage fall in price from 52 weeks high. This is where the price was 1 year back, and then we see what is the percentage fall in that particular script and what is the current price. So when the price falls considerably, it can become an opportunity for us to buy into, provided all ratios are intact. In this case, most of these companies have seen a fall of more than 50%. Except IRCON, whose price has fallen 26% from where it was 1 year back. That is from 471, it has fallen to 351. The highest fall was seen for both Jaypee and IL&FS. The least fall was seen for both IRCON at 26% and IRB Infra at 59%. Even though this fall is huge, considering that IRCON has fallen only 26%. Next, let us look at what is the profit that the company has earned on current share price. IL&FS has earned 32% on the current price of 3 rupees 60 paise. That is, it has earned 1 rupee 20 paise per share on a price of that share of rupees 3.60 paise. So this is good. IVRCL has made a loss on a price of 40 paise, 19 rupees of loss, which is very bad. IRB Infra has made a 28% earnings yield on a price of 81 rupees. Jaypee's earnings per share was 0 and the price was 1. Therefore, the earnings yield is 0. IR IRCON has earned 13.6% earnings yield, that is profit earned on the current share price. So this is good. So we want the earnings yield to be as high as possible. Next, let us look at the price earning ratio or PE ratio. This shows us how many times more we are paying for the earnings of the company of the current year. IL&FS earnings per share was 1 rupee 20 paise and the price was 3 rupee 60 paise each for each share. That is, we are paying 3 times more. So we don't want to pay more than 25 times. So this is good. So we can think of buying into this company provided all ratios are intact. But as we go down and see other ratios, it will become very apparent and clear that this is not a very good buy. IVRCL price earning is not there because the company had a loss of 19 rupees per share in 2018. These values are up to date till 2018 and the price we are paying was 0.440 paise. IRB price was 81 and the earnings was 23 rupees. That is, we are paying 3.6 times more for this earnings of 23 rupees. So this is also okay. Jaypee's price earning data is not available because there was no earnings in the company. IRCON's price earning multiple is 7.5 times. That is, for an earnings of 47 rupees per share, investors were willing to pay 350 rupees. So this is the highest valued stock in the group. So we don't want to pay more than 25 times the earnings of the company. Next, let us compare the current price earning with its historical price earning data of 5 years and 3 years. IL&FS in the recent year of 2018 had a multiple of 3 times, whereas since last 5 years the price was quoting around 11 times more than the earnings. In none of these companies I have any investments, but I'm doing this video for educational purpose to understand what kind of red flags can be seen through these companies. We can analyze the balance sheet and P&L account and look at the values, and it will become very apparent that many of these companies had issues from long, and if we were vigilant and careful, we would have very easily seen those data and understood that this is not the company that we should put our money into. IVRCL's data is not available. Same is the case for Jaypee, where current price earning is not available, although historically it was trading at 8.3 times, and over the period of 5 years the price was quoting 6.6 times higher than the earnings. Next, let us see how the net profit has got converted into cash, and out of that cash, how much was used in buying assets and how much was left over as free cash. So IL&FS had a earnings of 1 rupee 20 paise per share, but it didn't receive any cash. That is, none of this profit that the company showed per share was converted into cash. In fact, 8 rupee 90 paise went out of the business. Additional 8 rupee 90 paise other than 1 rupee 20 paise that was shown as profit. So this is not a good value. And not only the cash has gone out in the operations of the business, an additional 14 rupees was also invested in assets. So this is absolutely not a correct values to look at, because what we want to see is, like in IRB Infra, where the company showed a profit of 23 rupees, and out of that it earned it managed to convert this entire 23 rupees into cash. That is, the cash from operations was 60 rupees. But here also there is a problem that the company's free cash flow is negative, which means that the cash which came in, 60 rupees per share, this entire amount was used in buying assets. Over and above that, the company has invested an additional 52 rupees per share in buying assets. So it has invested more than what it has earned in the latest year. I'll also be analyzing the 5-year conversion of profit into cash and how much of that cash was left over as free. This is of the latest year. For the first 3 companies it is up till 2018, and the last 2 it is 2019. Jaypee's earnings were zero. There was no earnings in the company, and yet the cash coming in was 1 rupee 10 paise per share. Out of that, it still had 1 rupee left over as free cash. IRCON's earnings were 47 rupees. That is, this is the profit the company showed. But none of this profit has come into the business. In fact, 129 rupees additional has gone out of the company through its business operations. Over and above that, additional 164, other than 129, additional 164 has been used in buying assets. Again, not a good value. From here on itself, we'll understand why there is problem in these companies, because this management of the cash itself is not correct. For me, if the company has earned 23 rupees, even if it receives say more than 23 rupees in cash, it's okay. And out of this 23 or 24 rupees, 12 rupees should be left over as free cash, which can be used in the financing activity. In this chart, we'll be comparing the price with the OCF. That is, how many times more we are paying for what the company has earned in cash from operating activities in the latest year. IL&FS, this is not per share based values. This is the total value that we are looking at. Instead of the current market price, we are looking at the current market capitalization, and here we are looking at the operating cash flow in totality. That is, in 2019 or 2018, what was the cash the companies have received. IL&FS market cap was 47 CR. That is, the entire company, if somebody wanted to buy, it was available at 47 crores of market cap. The cash going out of the business was 116 crores through its operating activity. Generally, the company should be receiving cash in, that is, there should be cash inflows through the operating activity and not outflows. So if there is an outflow, then we need to look at the cash flow statement and understand why the cash has been going out of the business through its operating activity. So this is a negative value. IVRCL's entire company was available at 31 CR, whereas cash going out of the business in 2018 was 196 crores, again a negative value. Looking at IRB Infra, the company was available at 2,800 crores. Against that, the company has earned a cash of 2,135 crores, a 1.3 times multiple. That is, the price was 1.3 times higher than the company's cash earnings of 2018. So this is a good value. We don't want to pay more than 25 times the cash earnings of the company. Jaypee was also available at a reasonable 0.9 times its cash. That is, in fact, the entire company was available for 139 crores, and the company is showing that it has earned a cash of 158 crores in 2018, which itself looks very odd because if the entire company is available at 139 crores and if it is earning 158 crores, why are there no takers for these kind of company? So this looks odd. So as we go down below, we'll understand where the problems are. IRCON's entire company was available for 3,300 crores, whereas the cash going out of the business was 1,218 crores, which is a negative 2.7 times. So this is a problem also here. So we should always look for a positive cash, operating cash coming into the business. In terms of where the price is compared to the free cash flow left with the company, here too we don't want to pay 25 times more than the free cash flow of the company. IL&FS had a negative ratio, that is the company was available at 47 crores entire market cap and it had a negative free cash flow 186, meaning it has utilized 186 crores in purchase of assets and it doesn't have any free cash flow. Same is the case for IVRCL, where its ratio is negative. The entire company was available for 31 crores and the that is free cash flow was negative. We want a positive free cash flow out of the cash the company has earned through operating activity. IRB Infra also had a similar ratio where the company had negative free cash flow of 1,834 CR. This is of the latest year for Jaypee and IRCON and 2018 values for the first three companies. Jaypee's company was available at 139 and it still had a free cash of 134. So this is a good value. IRCON also had a negative free cash flow to price ratio. So we should be looking to buy into companies whose price to free cash flow is less than 25 times and not negative. Next we'll look at how much times more we are paying against the book value of the company. The book value is the value of the share as per the company's records. This is what the share is actually worth. IL&FS share price was 0, the book value was 0. As per the company's record, the net worth of the company is 0. This is because the company's net worth has turned negative. Let me show you by looking at the balance sheet. If we go to screener.in and look at scroll down to the balance sheet page, we will see that in March 2019 the reserves have turned negative. That is, the net worth has turned negative. This is the time to exit the company. Even in March 2018, the company's net worth had turned negative. If we go slightly ahead in the previous years, we'll see that in 2013 to 2014, there was a fall of almost 700 crore rupees in reserves. In the next year of 2015, there was another 300 crores of fall in the reserves. Here itself, this was very indicative that even if somebody was invested in 2013 and still didn't get out in 2014, they could still get an exit in 2015. Let us say that the investor is still stuck with this company and doesn't have the guts to take losses. In March 16, it gave a very clear indication that there is a huge problem in this company. From 1,044 crores, the reserves went down straight to 290 crores. So when the net worth of the reserve starts decreasing, that is the time to get out of the company. Not 1 year, but 2 years, 3 years continuous. 1 year we can understand that there is a loss, and because of the loss, the company's reserves have decreased. But what about 2 years in a row or 3 years? At least in 2016, here we are very sure that there is a problem, and whatever profits or whatever loss we can take, we should take and recover whatever capital we can out of the business. Whatever we're getting, take it and get out. We should not stay into these companies. Finally, in 2018 and 2019, it turned negative. IVRCL's book value was also zero. Let us look at this chart also. Right now we saw IVRCL. Let us look at IL&FS. If we scroll down to the balance sheet, here itself we'll come to know that in March 2010, the net worth had turned negative. That's okay. Now in 2011, 2012, we can see from 2011 it had turned positive, and back it had fallen quite considerably. So here also, if someone was still stuck in 2011, they can still get out in 2012. And let us say the investor still not wanting to take losses. Here definitely he should have got out in March 2014, where the reserves or net worth turned negative back again. 2015 saw a very mild positive in the net worth, but it again quickly turned negative. So there are many years the investors got to get out of these companies, provided they would have looked into the balance sheet of the company. The moment the net worth turns negative, we should get out of these businesses. Let us continue with our analysis. IRB Infra was available at 0.5 times its book value. That is, it was trading at a discount to its book value. So this is okay. Jaypee was available at a very heavy discount. That is, the company was saying that its shares are worth 20 rupees, but in the market, the participants or the investors were giving it a value of just 1 rupee per share. So that we are getting at a huge discount. Now, what is the reason that we are getting? Why should we get this company at such a heavy discount? What is the thing that we don't know, which the market knows? Because the market participants have given it a huge discount. That is, they have pulled down the price of the stock to 1 rupee, even though the company's records show that the share is valued at 20 rupees. This could be manipulation. This is something which you need to investigate. As we go down, we'll understand. IRCON's price to book value was available at 0.8, the highest in the group, which is good. Let us see. The price per share was 350 rupees, and as per the company's record, the share price was 422. So we are getting it currently at a discount. So this creates an opportunity. Only when all ratios are intact, all other ratios that we are going to analyze, they are within our benchmark. This is again a good ratio to look at, current market price to sales. Here we are looking at the totality, that is, we are taking the current market capitalization instead of per share basis, and we are taking the latest year's sales value. And then we are looking at how many times more we are paying for the sales of the latest year. IL&FS market cap was 47, and the company was generating revenue through sales of 1,869. Now, why would a company, how would a company manage to generate such a high sales, yet its market cap is just 47 crores? This looks very odd. IVRCL was a similar situation. The entire company was available for 31 crores, yet it was generating a sales of 729 crores in 2018. Whenever we see an extreme variation in price to sales, that itself is an indication that there's something wrong with the company. IRB was available at a ratio of 0.4, that is, the entire company was available at 2,800 crores and the sales it generated was 6,900. That is, the ratio between the two is of 40%. That is, the price was 40% lower or 40% of its sales. So this is okay. Although even I've given here also okay, because the sales it is generating is higher than its market cap. So it basically creates an opportunity to buy into the company. Jaypee was also available at a discount to its sales. That is, sales was 190 crore in 2019 and the entire company was available at 139 crores. Our construction sales were 4,700 and the company was available for 3,300. That is a multiple of 0.7. That is, the entire market cap was 70% of the sales it generated in 2019. So this is, we want to buy below 1 times or as near to 1 as possible. There is no fixed benchmark for this particular ratio. Next we'll look at the product of price earning to price book. Here we are trying to be more conservative in the sense that this is Benjamin Graham's formula, which basically says that the product of the price earning and price book should not be more than 22.5 times. That is, either PE should be below 15 and PB should be below 1.5, and the product of the two should not be more than 22.5 times. So as we saw earlier, my criteria for price earning is 25 times. That is, I'm willing to pay more than 25, around 25 times max for the earnings of the company. And for price book, my benchmark is 2.5. That is, I'm willing to pay 2.5 times higher than the book value of the company. But if somebody is more conservative or wants to buy much lower, then they can use this ratio. IL&FS, IVRCL and Jaypee all didn't have the products of PE and PB. Either price earning is missing or price book is missing or both are missing for these three companies. So we don't have the ratios for these companies. IRB, the product of the two was 1.6. Price earning was also very low and price book was also very low. So this is a good buy at this level. IRCON was also available at a good 6.2 price earning into price book. So this is also good. So these two companies can be looked into for further analysis. Next, let us look at what is the growth in the net profit since past 5 years, and if there was a growth in the current 3 years. IL&FS and Jaypee didn't have profit growth rates because the base year was negative for these companies. Now I'll quickly go to the P&L account and explain this as well. IL&FS, if you go back to screener, this is the IL&FS script, and if we go to P&L account, we see that in March 18 it had made a profit of 15 crores. But since 5 years back, that is 2012, in fact it should have been 2014, in between 1 year is missing of 2013, so we'll catch 2012. So even in 2012 the company had made a loss, and to calculate the profit growth rate is not possible since the base year, that is 2012, had a net loss. Therefore we cannot calculate a growth rate. Nonetheless, we see since 5 years the company has been continuously making losses. Now, when the company has been continuously making losses, it's a very appropriate time to get out of these company. Coming back, let us say in March 2019 or 2008, for example, somebody was invested and the company had made a profit of 90 crores. All of a sudden in 2019, it showed a loss of 473 crores. That's a huge loss compared to its previous year. So even if somebody has not exited in 2009, again in 2010, there was an additional loss of 251. So if you have not got out here, we can get out here at this in this year of 2010. So there are many years of opportunity the company gives, provided we look at these balance sheet and P&L account, and it is very clear here that the companies have been making continuous losses and we should not stay in this company. Even if we are stuck in this company, we should take whatever losses we can and just put that money into a good fundamental company. Coming back to the chart, IVRCL saw a degrowth in its profit of by 67%, and in the recent 3 year the profit has fallen by 27%. Here we see in 2018 the company had a loss of 1900 crores, and 5 years back also it had a loss. That is, since 2013, from 102 crores the loss increased to 1000 or almost 2000 crores. So that is a degrowth of 67% in profit. And if we look at the recent 3 years, the degrowth is 27.86%. That is, from 15, the profit has fallen, as further increased to 2000 crores approximately. So that's a 27% fall. So this is not good for these companies. IRB has seen a growth in its profit from both 5 and 3 years. Although I have given it a negative value because I want those profits and sales both to be growing at least 10% and above every year. So here the profit is below 10%, but in the recent 3 years the profits have managed a growth of 15.5%. All of these data is very easily available in screener.in, and we don't need to go anywhere to collect the data for analysis. Although I have converted this data into graph because it is easier for me to explain through graph than through just using figures like in this chart. So here it looks more interesting to understand, and even in fact it is much easier to understand when I convert the data into graph. This is not provided by Screener. IRCON's last 5 years, the profit has been falling at the rate of 10%, a negative value. But in the recent 3 years, it has seen a growth of 3.9%. So this is also very low. So we see here that the profits have been growing. In fact, from 5 years back, that is in March 14, it had made a profit of 741 crores. And in 2019, the profit fell to 450 crores. So there's definitely a pressure on its profit, and the company's profit margin or profit growth rate has been decreasing from 5 years on. Let's move on to the next chart. Here we are looking at the PEG ratio, which is the price earning divided by the profit growth rate of 5 years. When we look at the PEG, it basically tells us what is the price we paid for the earnings and if that is justified. And whether it is justified, we can come to know by looking at the growth in earnings over the last 5 years. IL&FS Jaypee didn't have any data because either the price earning was not available or the profit growth rate was not available because of the losses. Even IVRCL price earning data was not available, so we don't have the ratios for these three companies. IRB's PEG was 0.4, which is good. I want the PEG to be below 1.5 and above 0. IRB's price earning was 3.6 times. That is, you're paying 3.6 times higher than the earnings. And that earnings over the last 5 years was growing at 8.4%. So it's a good buy at this price earning because we're getting it at a multiple of just 0.4. As I mentioned, the PG is calculated by dividing the price earning with profit growth rate of the 5 years. That is 3.6 divided by 8.4. IRCON, the price earning multiple was 7.5 times. That is, investors were willing to pay 7.5 times more than the earnings. But there was no growth in the earnings. In fact, there was a degrowth in the earnings of 10%. So why would you pay 7.5 times when the company's profits have been falling or are having a degrowth of 10%? So this is not a good buy at this price earning. So we should expect this price to either fall or the profit growth rate to go back up again. Only when the PG is below 1.5 and above 0, that is the right time to buy into the company. And of course, all other ratios being within the benchmark. We'll also look at the profit growth rate of the 3 years and divide that by the price earning to get a PG of 3 years. That is, we are trying to understand in the recent 3 years what was the growth in profit and the price earning we are paying, is that justified? Again, here too, IL&FS, IVRCL and Jaypee's data is not available. Either price earning is missing or the profit growth rate is missing. IRB price earning of the latest 12 months was 3.6 times, for which the company's profits have been growing at 15.5%. So again, a very good PEG of 0.2. IRCON price earning multiple was 7.5 times, but we are not getting a very high growth rate. We're just getting a 3.9% growth rate in the recent 3 years in its earnings. That is, the PEG is 1.9, above my benchmark of 1.5. Some investors would even want to buy at below 1 times. That is, only when the price earning and the profit growth rate are equal, that is the time to buy into the company. So I'm little more liberal in the sense that I'm willing to give even 1.5 times of PEG. Next, let us look at what is the compounded growth in sales over the past 5 and 3 years. This very clearly indicates whether there is demand for the company's products in the market. As I mentioned, this video is not about analyzing these companies in specific, but it is more about understanding how to analyze any companies and understand what these ratios are telling us. And here IL&FS has seen a degrowth in its sales of 3.3% since 5 years back. That is, the sales has been falling at the rate of 3.3% compounded over the past 5 years. And in the recent 3 years, it has seen a further degrowth in its sales of 12.4%. That is, sales has been falling continuously. If you look at the screener.in, we can see in 2018 the company had generated 1800 crores of sales. Of that, 5 years back the sales the company managed to do was around 2200 crores. So there is definitely a drop in the sales from where it was 5 years back. Even when we consider the recent 3 years also, we see a degrowth in its sales. IVRCL has also seen a huge fall in its sales from both 5 and 3 years back. IRB has seen a growth of 9.1% in its sales since last 5 years and 14% since recent 3 years. So it has managed to gain further in terms of sales. So this is a good value. Jaypee has seen a negative value. In the recent 3 years, the sales has been falling at a very big scale at 61.2%. Not a good value to look at. Let us check the Jaypee's P&L account. In 2019, the sales have fallen to 190 crores, and 5 years back, approximately it was 3,300. So we can see huge fall even from 3 years back at 3,255. There's a huge fall in its sales. There's a huge degrowth in its sales. IRCON has seen a growth of 4.3% since 5 years back and a 24% growth rate in the recent 3 years. So this is a good value. So we want to see sales growing at least 10% year on year. Next, let us look at what is the net profit generated on the shareholders' equity over the past 5 years and in the latest year. The formula we use for this is the net profit divided by the equity plus reserves. Here we are trying to find out on our money what is the profit the company has generated. For IL&FS and IVRCL, we don't have the data because these companies have been generating losses on shareholders' money for both 5 years, that is over the period of 5 years, and even in the latest year. So this is not a good thing to look at when we analyze a company, that it is making losses over a period of last 5 years on average. IRB generated a return on equity of 14.2% over a period of 5 years. This is slightly below my benchmark of 15%. But in the recent year, the return on equity was 15.2%. So this has become better. The reason why IL&FS ROE are blank is because its net worth were negative. Let me explain this. This is the screener's balance sheet of IL&FS. Here we can see inside the reserves, the company's reserves were showing negative, meaning its net worth was negative, meaning it had no balance left to pay shareholders in case of liquidation. Therefore, we cannot calculate the return on equity because the equity itself is negative. And not only is the equity negative, but if you go to the P&L account for March 2018, we can see it has been making losses since last 5 years, except for March 2018, where it made a minor profit of 15 crores. So, return on equity cannot be calculated for companies which have negative net worth. Same is the case for IVRCL, where its net worth was negative in March 2019. It had a negative net worth of 3,306. So an investor who is already invested, let's say even in March 2013, and in March 2014 the company had a loss and the net worth decreased, or the equity plus reserves decreased to 1300. That's a fall of around 600 crore rupees. So here one can exit if someone didn't have the inclination or didn't want to exit even here. Even in 2015 it gave a very clear indication that 2 years in a row there was a loss, and the net worth has further reduced to 1044 cr. Even in March 16 there is an opportunity here to definitely someone has to exit, because there's a straight out fall from 1000 crores to 290 crores. There's no way one can stay here at this point of time invested in the company. Whatever may be the profit, whatever may be the loss, in fact, the investor has to take that out and just discard out or get out of this company. I think similar was the case for IL&FS, where if you notice even since March 2010 it has been turning negative. It turned positive back in 11-12. The reserves turned back into positive, but again from 14 onwards it turned negative. Here no one should stay invested in this company even if it turns back positive again. So the company or the balance sheet has given enough red flags to indicate that the investor should now exit out of these companies, even if with a loss, whether major or minor loss. There's nothing like if the investor is suffering a minor loss, and he should take it and come out of this company. Jaypee's net worth over the period of last 5 years had turned negative. Only let us go and analyze this company. It has made a loss even in 2018, a loss of 1921 crores. But if we go to the balance sheet, we see that its net worth is still positive, even over a period of 5 years. Since we didn't have the data for 5 years, it is not plotted on the graph. But on a equity base of 1300 plus 1600, that is 2900 or 3000 approximately, the company has made a loss of 1921 crores. That is an absolute no-no for any investor who is looking at these companies. So here in the latest year it has suffered a loss of 46.8%. IRCON also had a low ROE of 12 and 11% over the 5 years and even in the latest year. This is the averages of all the companies. We can ignore this for time being. Let us look at the return on assets. That is, what is the EBIT these companies have generated on fixed assets and working capital employed into the business over the past 5 years and the latest year. The formula for this is EBIT divided by the average fixed assets plus working capital of 2 years, of the latest 2 years. Here in return on assets, we want it to be as high as possible. This is the top line profit these companies have generated on their fixed assets and any working capital employed into the business. So in this return ratios, we are trying to understand the profits these companies are generating on equity, on assets, on capital employed, and so on. IL&FS has generated 9.1% on its assets employed into the business. But in the previous graph we saw return on equity was its net worth was negative, but it had an assets on which it was generating 9% over a period of last 5 years and 17% in the latest year of 2018. IVRCL has been generating losses since last 5 years on its assets employed into the business. Even in the latest year, it had made a loss of 9.8%. Let us go back to IL&FS and check on the assets. Are these returns correct? So in March 2018, it had a slight positive profit growth, in fact net profit of positive, and its assets were around 180 crores plus the working capital changes, that is other assets minus other liabilities. It had other assets of 4,800 crores and other liabilities of 2,800 crores. So this was the total assets that was employed into the business of the company, and on that it has generated a profit of 15 crores. Now why this ratio is showing 9.1% over a period of last 5 years and 17% over the recent year is because screener in its EBIT calculation, it does not consider or it excludes or includes the extraordinary items. That is, if the company had made extraordinary losses in any 1 year or multiple years, it adds it back into the EBIT, and if the company has made extraordinary gain over these periods, it will remove it out. So this value of the profit or the return is excluding the extraordinary items. This is the scenario or case for all the ratios which are written ratios. IRB has generated 11% ROA over the period of 5 years, and in the latest year it was 11.9%. So this is alright. Jaypee over a period of last 5 years has been generating, in fact the data is not available. We'll go and check this later on. And in the latest year it had generated a negative ROA. This, we would never want to invest in a company which is not employing or generating profits, or at least not even in the 1 year, but over a period of 5 years. If it's not generating, then it's a definite no for the investment. Like in IVRCL, where over a period of 5 years it has been generating losses even on the assets. Forget about the net worth. Net worth has already turned negative. IRCON over a period of 5 years has generated 14.5% ROA, and in the latest year it is 8.9%. Let us understand why Jaypee's 5 years data is not available. So we see it had an asset base of 10,800 crores and it had other assets of 8,000 crores and other liabilities of 7,000 crores. So what has happened here is that since we don't have the data for 5 years, it has not been plotted on the graph here. So we can ignore this. This is the average of the company's return on assets. So this also we can ignore. In this chart, we'll look at the net profit these companies are generating on the source of funds. That is from where it is getting funds. That is through equity, shareholders' equity, or through borrowings. So the formula for this is net profit divided by the net worth of the company plus the borrowings. So here we are trying to understand the profitability of the company on net worth plus borrowings. IL&FS, IVRCL, IRCON, all these companies, even IRB Infra, have been generating very low return on capital employed. Here we want the return or profits on the source of funds to be more than 15% at least minimum. In fact, none of these companies have managed to generate a 15% above ROCE. IL&FS had generated negative returns over the period of last 5 years on its net worth plus borrowings. Considering the entire sources of funds that these companies have, and on that what is the profit it is generating, so it's generating losses. Now why would we want to invest in a company which has been generating losses on its whatever it has borrowed plus the shareholders money? And in the latest year it was a minor 0.5%, which is absolutely not okay. IVRCL has made losses of 14% on the total capital employed over the period of last 5 years. This is where itself we should end our analysis for this company. IRB has generated very low returns on its total source of funds. Jaypee in its last 5 years has generated 195%, which is good, but this again has a problem because we have to look at whether this value, because this is an exception, we cannot take this value at its face value, because generally we don't see these kind of returns. In the latest year, it had made losses on the capital employed. IRCON has generated a decent 8% over a period of last 5 years, but in the recent year of 2019, the return on capital employed has decreased to 5.4%. So in this case, only IRCON has managed a above decent average, above average of all of these companies, although it is very low as per my benchmark. Next, let us look at what is the sales turnover on the capital employed in the latest year. Here we are trying to understand how many times more the sales was compared to the capital employed into the business. So the higher the sales on the capital employed, the better it is. The formula is annual sales divided by the capital employed. IL&FS has generated lower sales than what it employed as capital. Here the capital employed was 2,500 crores and the sales was 1,869 crores. So the sales is below the capital employed. Generally, we would want to see more sales happening against the capital employed. That shows efficiency of the business. IVRCL has generated a very low multiple against the capital employed. In fact, all of these companies' sales are below its capital employed. Although this is still okay because it is very near to the capital employed for IL&FS, and even for IRCON, the sales generated is nearby to the capital employed. Although we would want to see a ratio of at least 1 time or above that. That is, the sales being very near to what was used to generate that sales or above that. Next, let us look at what is the net profit generated over the period of last 5 years and how much of that net profit has actually come into the company in terms of cash. IL&FS has generated losses over the period of last 5 years of 565 crores, and none of that has got translated into cash. In fact, an additional 523 crores has gone out of the company other than the profit the company had shown, or in fact the losses the company had shown. So it is 8% below its net losses. IVRCL had made losses of 3,900 crores over a period of last 5 years, and the cash going out of the business over this period of 5 years was 1,374. Again, not a good value. IRB Infra had shown a profit of 3,100 crores, against which it received a cash of 11,000. So this is the kind of value we would want to see in our companies. That is, it has generated 250% more cash than what it showed as net profit in the company. Jaypee's losses were 2,600 crores over a period of last 5 years, and yet it is showing a cash inflows through operations of 5,240 crores. So although this is okay, but we don't want to see losses in the company. We would want to see both figures as positive, both the net profit as well as cash coming in against that. So this is a negative. And IRCON's case is that it is generating a profit of 2,000 crores over a period of 5 years, yet there's a cash outflow out of this company of 974 crores. So again, not a good value. Here too, what is happening is the company is showing profits, but none of these profits is actually getting translated into the cash over a period of 5 years, that is. In fact, we see an additional 974 crores going out of the company. So in this case, only IRB has done well of generating both positive profits as well as positive cash flows through operations. Next, we'll look at how much of that cash flow which was generated or not generated for that matter, and of that, how much was left over as free cash and how much was invested by these companies in acquiring assets or buying assets. IL&FS, we saw earlier, didn't have any cash coming in through operations over the period of 5 years. Not only that, but it has also invested an additional 724 crores in purchase of assets. This is an absolute no-no. Why would a company which is not generating any cash over a period of 5 years yet investing in assets, continuously acquiring more and more assets? This is a kind of a red flag. Unless and until there is a high growth in these companies and they do require assets or investment in assets continuously, but then it should also be generating cash against those assets. What is the use of continuously buying assets or putting more and more money into the assets even though the company is not generating any cash through its operating activities, at least over a period of 5 years, that is. So this is down. IVRCL had the similar case where not only the cash is going out of the operations, but it is investing more and more into acquiring assets. IRB's cash coming in was 11,000 crores. Out of that, it has invested, or its free cash flow in fact is 3,700 crores. That is 3,700 crores has gone into, the free cash flow is negative, meaning entire 11,000 was invested in acquiring assets out of this cash. So that is okay, but then it has spent an additional 3,000 crores in acquiring assets. So this is not a good metric to look at. So this is also negative. Jaypee's cash was 5,200 and its free cash flow was 3,800, meaning only 26% of this 5,240 crores was spent on buying assets. So in terms of conversion of cash or buying of assets from this cash, all of these companies have managed very poorly. In fact, their investments in assets is huge compared to the cash generated by these companies. So this is definitely a negative for me. for all of these companies except Jaypee. But now Jaypee also, we have to analyze other ratios to see if it is managing other ratios properly. We already saw for Jaypee that it is generating very low return on assets, low return on capital employed, and so on. Now let us look at the same thing but for the latest year, that is the net profit these companies have shown. Out of that net profit, how much has come into the company as cash in the latest year? IL&FS has shown a cash or a net profit of 16 crores, but again no cash is coming out of the from that profit. In fact, the company's cash going out of the business operation was 117 cr, again a negative value. Same is the case for IVRCL. In fact, here not only is the company shown losses, but an additional 190 crores has gone out of the company as cash. IRB has shown a profit of 835 crores in 2018 and the cash coming in is 2100 crores. So that is good. We want to see a value which is like this. Jaypee has shown losses, yet 159 crore is coming in as cash, again a negative value. And IRCON's profits were 441 crores, yet the cash going out of the business is 1219 crores. So again not a good value. So we have to understand these kind of all these ratios to see how the company is managing its cash and how much of that cash it is using to buy assets and how much of that portion is left over as free cash to be invested in financing activity. In this chart, we are looking at the growth in net profit over its 5 years average. This is the latest 12 months net profit. IL&FS had made losses of 113 crores over the last 5 years, and in the recent year it's showing a profit of 16 crores. So this is still a negative value. When we see in the last 5 years it is making losses, there is no use looking at how much it has gained from the average. Same is the case for IVRCL. Not only in the last 5 years on average it had made losses of 790 crores, but in the latest year the losses have further increased to 1300 crores, a negative value. IRB, this is a good value because in the latest year the net profit was 806 crores and above its 5 years average. Jaypee has got a negative value. It's the same case as in IVRCL. So again, if the company over a period of last 5 years is making losses of 535 crores, we don't want to invest in this kind of companies. Although we saw that the companies in the previous chart, the cash generated was positive, yet we don't want to invest in companies over a period of 5 years is making losses. This is the chart for Jaypee Infratech. Here we can see the company has been generating losses over a period of 5 years. So we should not be buying into these companies over a long term when we look at the long term picture. IRCON profit of the current year is 2% above its 5 years average. So this is also a good value. Worst case scenario, if somebody wants to still invest in infrastructure sector, then only 2 companies according to me comes or are okay, or not even okay. I would not still invest, but if somebody still wants to invest, then IRB and IRCON are the only 2 companies which can be looked into, but not for long term, because the return ratios are very poor for these companies. Even the cash flow generations and free cash flow is very poor. Here in this chart, we're looking at the YOY growth rate, that is how the profit has grown from 2017 to 2018 for the first three companies, and how the profit has grown from 2018 to 2019 for Jaypee and IRCON. IL&FS had made a loss of 101 crores against a profit of 16 crores in 2018. So there's no use of calculating the growth rate because the base year itself is negative. Same is the case for IVRCL. In fact, here in 2017 the loss was 128 crores, that increased further to 1500 crores. So again a negative. We also have to consider, keep in mind that all of these profit figures are excluding the extraordinary gains and extraordinary losses. That is, if the company has generated extraordinary gain, then that is removed out of the profit figure, and if it is generated losses, extraordinary losses, it is added back. The reason for doing that is that it shows the correct figure of net profit, in the sense that extraordinary items are generally not repeated or they don't get reflected every year. So if it's an exceptional item or an extraordinary item, we can neglect that. IRB's profit growth year on year was 17%, again a good value. Jaypee's losses have further increased from 989 to 1920 in 2019. Absolutely not a good value. So Jaypee is also out of the analysis. IVRCL is out of the analysis. IL&FS, of course, since both of these had negative net worth, they were completely out. But for the analysis purpose, I'm continuing looking at all these ratios so that investors can understand how these ratios can affect the companies. IRCON's current year's profit was 9% above its previous year. That is, in 2018, the company had generated a profit of 406 crores, and in 2019, it showed a net profit of 441 crores. Let us look at the very near-term picture as to how the company is managed to grow its sales over its previous year's quarter, as well as the profit. IL&FS sales and profit growth data is not available. If we use the standalone values for IL&FS, we see that the sales from June to June quarter has slightly increased, minor growth in sales, but a loss in net profit, a huge loss in net profit. For IVRCL, the company's sales has dropped by 29% over its previous quarter. So this shows that there is issues in this company in terms of managing to grow its sales. It's showing a profit of 49%. So this is doubtful. We'll have to look at the actual values here for IVRCL. So although the sales has grown from the sales has dropped from 203 crores to 117 crores, which was reflected in the graph, and the profit also dropped from 344 crores to 380 crores. So it has been making losses continuously over so many quarters, continuously over a period of 12 quarters. So here this is also a negative score. It's not a positive 49% but a negative 49%. So I have corrected the data for IVRCL. IRB Infra sales has increased by 15% over its previous quarter, but the profit has dropped by 17%. So there's definitely a margin pressure on this company. Jaypee Infrastructure's Infratech's data is very erratic in the sense that when we go to screener, we see that the quarterly results are not up to date correctly from June 2019 straight away to March 2019 to June 2018. So there are a lot of quarters missing, and in fact between March 16 to March 18 also there are a lot of quarters missing. Data for quarters are missing. Only when we look at the standalone values we see the data available, and from June to June we see a growth in its sales, but losses, continuous losses in that sense in its net profit. IRCON's sales have increased, but the profit has dropped by 15%. Now this is a very important chart to look at, which I was referring to in return on equity, that both IL&FS and IVRCL's net worth has turned negative. So here we are comparing we are looking at what is the net worth of these companies. That is, what is it actually worth after if we have to sell all the assets and pay off all the liabilities. How much would be there for the shareholders? That is the actual net worth of the company. Against that, what is the contingent liability of these companies? So contingent liability are those liabilities which are not reflected in the balance sheet, and they are not accounted for, and these liabilities can arise in the future for which the companies would have to pay. So as per my benchmark, I don't want the contingent liability to exceed or be more than 20% of the net worth. Here in the case of IL&FS, we can see very clearly that the company's net worth has turned negative 139 crores, and yet it has a liability, a contingent liability of 1705 crores. So how would it pay this liability if its net worth itself is negative? Same is the case for IVRCL, where not only is the net worth negative, but it has a huge contingent liability of 10,000 crores, which would arise in the future. IRB has managed its contingent liability below 20% of its net worth. Jaypee's contingent liability is very high at 81% of its net worth. Its contingent liability is almost 2,400 crores. Again, not a very good value. I would not invest in companies which have very high contingent liabilities. IRCON contingent liability has exceeded my benchmark to 28%, although it is still okay, plus or minus a few percentage, but it's still a negative value for me. Let us look at how much these companies' debt was against the equity contribution, that is against the two sources of funds these companies have, that is equity plus borrowings, which is contributing more to the source of funds. IL&FS debt was 2,643 crores against a negative net worth of 139 crores. So I fail to understand how this company would pay its borrowings or its debt when its net worth itself has turned negative. I also don't understand how banks or financial institutions keep giving loans to these kind of companies, and investors, when they look at all these numbers, they fail to understand that there is some manipulation going on in the company. It is a very clear red flag, as I indicated earlier also. Same is the case for IVRCL, where its debt was 7,000 crores, but yet its net worth was negative. IRB's debt was 15,000 against an equity contribution of 6,315 crores. Again a 2.5 times multiple. That is, debt was 2.5 times higher than the equity contribution. I would not invest in any company whose debt is 1 times or more than 1 times of its equity contribution. So here it's a clear no for me, because whenever the company's debt is more than 1 times, it means it will also have to pay more and more interest in terms of finance cost against the borrowings it has done. Jaypee's debt was also very high at 2.9 times its equity contribution. IRCON is the only company which has managed to keep its debt to equity ratio below 1 times. So don't invest in companies which have very high debt, because when the debt is high, they have to pay more interest cost. When they pay more interest costs, the net profit goes down and the profits coming to the shareholders decreases, and that's a burden on the company. Next, let us look at on the borrowings, what is the profits these companies are generating in the latest year. IL&FS total debt as of 2018 was 2,600 crores and the profit it generated was just 16 crores. So there's a huge gap between the two of them. How would it pay this debt using just 16 crores of net profit? That's not possible. IVRCL has been collecting a debt of 7,000 crores till 2018, and in 2018 itself it made a loss of 1,500 crores. So how would it pay this debt? We have to keep asking this kind of questions to understand what is the position of the company in terms of servicing its liability on its debt. IRB's debt was 15,000 and the profit generated was 835 crores. That is, it will take 17 years. If we consider this net profit of the current year, it will require 17 years to pay off this debt. That too only if the entire profit is used up. So most of this profit may not be even converted into cash. So that also has to be taken into consideration. So this is also not a good value. Max to max we can go is above 7 times. That is, within 7 years, using current year's profit, it can pay off that debt. So the debt portion should not be very high against the profit it is generating. Jaypee has made a loss in 2019 against the debt burden of 8,800 crores. Absolutely a no value for this company too. IRCON's debt is 6.8 times higher than the profit it has generated in 2019. So this is okay, slightly below my benchmark. Very important ratios these are very important ratios that investors should definitely look at to understand the internal position of the company. Next, let us look at the interest coverage ratio. This is the EBIT the company has generated, and on that what is the interest cost or interest burden on it. IL&FS EBIT or earning before interest and tax was 389 crores. This is the top line profit, or the profit which is the operating profit plus or operating profit deducting the depreciation. So the company's profit was 389 crores against which it paid an interest of 409 crores. So that's a ratio of around 1 times. So we don't want to invest in companies whose interest coverages is less than 4 times. That is, its EBIT has to be at least 1200 crores. Against that, it has to pay, even if it's paying 400 crores, it should be generating at least 4 times more profit than what it is paying as interest. So again, a negative value. IVRCL had a loss of 509 crores in 2018, yet it had to pay an interest of 1000 crores. So the interest never stops. The company has to keep paying whether it is making profit or losses. It has to keep paying the interest, otherwise the bank would take it into liquidation. IRB profit was 2300 crores. This is for the latest year we are considering, or for whatever latest year the companies have shown their results. Against that, its burden of interest was 976 crores. That is a 2.2 multiple. Again, a low value as per my benchmark. Jaypee's was suffering a loss in 2019, yet it had to pay a interest cost of 1100 crores. Again, a negative. IRCON was the only companies which had generated a profit of 624 crores and paid an interest of only 15 crores. That's a 43 times multiple between the interest and EBIT. But we have to look at whether this is the genuine figure or not by looking at the this is the IRCON's P&L account, where it is showing a 481 crores of operating profit and an other income of 209 crores. So that's a total of around 600 plus, so say 700 approximately. On that, its depreciation was 52 crores, so we deduct out of that. So out of that 700 crores, 50 has gone, so 650 crores is left over as the EBIT. On that, it is paying an interest of just 15 crores. So its interest cost has always been low throughout the many years. So this value is genuine. So this is a good value. This is also a very important chart or values to look at. This is the promoter holding in the company, and if the promoters have made or done any pledge of their shares. IL&FS had no pledge of their shares as of now, and the promoter holding was 42%, so this is okay. But we have to look at the very latest data as well. IVRCL's pledge was 100%. That is, the promoter holding was not only very low at 5%. Here, I want my promoters, the company's promoters, to be holding at least 30% in the company, which shows that they have a high incentive in running the business well, and they should not be making a pledge of more than 20% of their holdings. So in this case, both the values are negative. Not only the promoters holding is very low, but the promoters have pledged entire shares with banks, which in a way, directly or indirectly, the promoters have exited this company. They have taken out money out of this company. IRB's pledge shares was 0 and promoter holding was good. Jaypee Infratech, again a very high pledge of 84%. I don't want the promoters' pledge to exceed 20% of their holding. Although their holding is very high at 61%, their promoters have pledged almost 84%, which means that the promoters have taken out money on their shareholding out of the company. Whether it is for personal use or putting it into the company doesn't matter. When the company's promoters start pledging more and more shares, that is a red flag. So what would happen in this case is that if the promoters don't remove this pledge from the banks, that is, if they don't release this pledge by paying money back to the bank, then the banks would mostly sell off this shares in the open market at whatever price they can get. So that would definitely put a lot of pressure on the price, and many times you'll see a fall of 20-25% and almost 50-60% or even more in the share price of these companies which have pledged a high percentage of their holdings with the banks. IRCON's pledge was 0 and the promoter holding was also very high. So this gives a lot of confidence that the promoter's interest or incentive is very high in running the business well. So as I mentioned earlier also, only two companies, IRB and IRCON, can be considered for investment purpose. Although I would still not invest because the return ratios are very poor. The cash conversion is very poor. In this chart, we are looking at what is the raw material cost percentage of the total sales the company has done in the latest year. IL&FS sales were 1,869 crores. Of that, only 29% was the raw material cost. For a company which is into construction and infrastructure development, how would the raw material cost be so low? That has to be considered. IVRCL's raw material cost as a percentage of sales was also very low at 16%. In fact, if you see, most of these companies' raw material cost was very low. Now, what is the reason for that has to be looked into. IRB's total sales were 5,600 crores in 2018, against which its raw material cost was just 1%. So let us quickly look at the ratio for IRB. Where in screener we can see that its sales was 5,694 crores. Of that, its expenses, the material cost as a percentage was just 4%. The manufacturing cost was 35%. So these companies have manufacturing cost, a major manufacturing cost than their material cost. Employee cost was just 4% and other cost was 3% of the total expenses of 2,789 crores. But nonetheless, I've given them negative values because these are moved to the manufacturing cost. Next, let us look at the debtors to sales ratio and understand how much payment was still to be collected from the debtors or customers against the sales these companies have done in the latest year. IL&FS sales was 1,800 crores. Against that, it still has to receive 495 crores from the customers, which is a 26.5% of the sales, which is a good value. I don't want the payment to be collected from customers to exceed 30% of the sales. IVRCL's debtors were 1,000 crores. Here, IVRCL's debtors to sales ratio is showing 137%. But in the recent 12 trailing months, it was 643 crores. So we have to consider the recent 12 months data of sales, that is 643 crores. Against that, if you scroll down to the other assets and look at the trade receivables, it still has to collect 1,000 crores in as of 2019 against a sales of 643 crores. So that's a very negative value, meaning the company has done only sales of 643 crores, yet it has to collect 1,000 crores from the customers. It shows a very high inefficiency of the company. IRB's collection from the customers was 1.6% only, so this is a good value. Jaypee's was again the same. It did a sales of only 190 crores, against which it had to collect 239 crores from the customers. Again, a very negative value. I would not invest in any companies whose collection from debtors exceeds 30% of the sales of the latest year. Very important to understand these values. Next, let us look at within how many days these companies are collecting payment from the customers, other than what were the debtors against the sales. As we saw in IL&FS, 26.5% of the payment was yet to be collected from the customers against the current year's sales. Of that, it is collecting these payments within 97 days in the recent year, and it was taking 103 days 3 years back. So this is very high. My benchmark is 90 days for the collection period, or 3 months max. IVRCLs, not only the debtors to be collected were more than the sales, but it is taking huge amount of days, 308 days to collect that payment from the customers. 3 years back it was taking 192 days, which is again a negative values. IRB debtors were only 1.6% of the sales of the current year, and it is taking only 9 days to collect that payment. So this is very efficient. Jaypee, again the ratios were not good. 458 days to collect the payment is huge number of days to give credit to customers. And not only that, against the sales of the current year of 2019, the debtors were 125% more than the sales. IRCON had a good ratio. Its debtors were just 13.9% and collecting within 51 days. In fact, it has improved from 3 years back, where it was collecting in 75 days. Next, let us look at the debtors versus the creditors, that is against the customers, while comparing with the suppliers. Are the suppliers willing to give credit to our companies? And if they are, then there is some reputation of those companies in the market. IL&FS debtors, or payment to be collected from customers, was 495 crores against the pending payment to the suppliers was 967 crores. So although this is good, meaning the company is working more with the suppliers' money or creditors' money, that's a good thing. In fact, all of these companies were working with the creditors' money, then meaning the payment to be collected from customers was less than what it had to pay to the suppliers. The average operating profit margin of the last 5 years should be more than 15%, and the latest net profit margin should be at least about 10%. IL&FS, IVRCL and Jaypee, none of these companies have managed a good OPM or NPM profit margins. In fact, IL&FS has been making loss in the latest year of 2018 at 0.8%, and in fact in 2017 it had made a loss of 2.6% on its sales. The OPM was also very less at 3.6%. IVRCL's OPM from the last 5 years on average was negative 8.8%. In fact, the profit margins were negative 140% and minus 6.4%. Not a good values. IRCON has also been having a low OPM of 12.7% over the average of last 5 years, whereas the NPM was okay in 2018, but in 2019 it has dropped below 10% benchmark. IRB, the OPM over the last 5 years was very high, because of which it managed above 10% of NPM for both 2017 and 2018. Jaypee, even though was having above benchmark operating profit margin of 15%, yet it could not convert that operating profit margin into the net profit margin. It had a negative NPM for both 2019 and 2018. Absolutely not a good value. Next, let us look at the liquidity position of these companies by looking at the current ratio. The current ratio is calculated by removing current liabilities from current assets, and to understand whether the current assets are enough to clear off or service the liabilities or the current liabilities of this year. IL&FS current assets were 2,243 crores against current liabilities of 1,899 crores. So this was having a comfortable current ratio, which would mean that the assets were enough to pay off the current liabilities of this year. IVRCL's liabilities were more than its assets by huge margin or huge multiple. It had a negative working capital of 7,899. If it has to pay all its liability in this year, it won't be able to, because its assets are only 3,483 crores. IRB also had a similar situation where its assets were lower than its liabilities. Again, a negative for this company. Jaypee had a positive working capital of 1,028 crores and a current ratio of 1.2 times, meaning assets were 1.2 times more than the current liabilities. Similar was the case for IRCON. Next, let us look at the total assets of these companies at its acquisition or cost price and how much of this gross block has been already depreciated to the P&L account till date. IL&FS had an asset of 265 crores at acquisition cost. Of that, 32% has already been transferred to the P&L account. So the company has a very low asset base compared to the other peer group companies. Although most of the, not most, but 32% of that has been depreciated. So this is a good value. Anything above 30% should be considered okay. I have already explained these in detail in my previous videos. If someone wants to look at and understand in detail about gross block and accumulated depreciation, they can follow those particular videos. IVRCL's assets were 438, against which its accumulated depreciation was almost 50%. So this is also good. Although I am analyzing these two companies as well as Jaypee, but they are not worth investing because their net worths have turned negative, at least for IL&FS and IVRCL. Jaypee is also not doing very well. Some ratios will be okay, some ratios won't be, but if the ones which are very important, like the net worth, which we saw earlier, the book value and all those things, then we should skip investing in those companies. IRBL's assets were huge at 31,000 crores. Of that, again here also we can see a manipulation going on in the company. But just looking at this ratio, out of this 31,000 crores of assets, only 476 crores have been depreciated till now. This is not a new company, it's an old company. And that is only just 2%, which is a red flag for me. How come a company whose assets are at 31,000 crores has only managed to depreciate, or total accumulated depreciation till now is just 476 crores? Again, a red flag for me here, meaning there is some problem here in this particular ratio. Similar was the case for Jaypee, where out of the 11,000 crores, only 319 crores has been depreciated. That is only just 3%. Even for IRCON, just 6%. So what happens is, if the company's accumulated depreciation is above 30% means most of the assets have already been depreciated or expensed out to the P&L account, because of which the P&L account will definitely go down. But when the company's accumulated depreciation is so low, it means it is not properly depreciating its assets to the P&L account. If they would have done that, their profits margin would have come down. Similar is the case for all the three companies. I would definitely look more into this particular numbers of the assets and accumulated depreciation to understand why these companies are depreciating their assets at such a low percentage rate. Next, let us look at the net block, that is the gross block less accumulated depreciation. This is the assets of the company after removing the depreciation. And what is the depreciation rate being charged every year, or at least in the latest year, on this net block? So this will help us understand whether the company is doing any manipulation in terms of depreciation rate charged. If the company's depreciation rates are very low, then that would mean that the company is inflating its profits. Now, since these are infrastructure companies and their assets generally are consumed over a long period of time, say 10 years, 20 years, the depreciation rates would generally be low. Not necessarily, but it would generally be low. So IL&FS is depreciating its assets at 25%, which is a good way, because that shows that the company, at least in the sense that it is not manipulating the depreciation being charged to the P&L account. IVRCL was charging 35% on its net block. IRB, as we saw earlier, even the accumulated depreciation is very low, and even the depreciation rate is very low, of 3%. So this needs to be investigated further, which I'm not going to do in this video, but at least when we see such a low percentage, it should raise a concern about how slow these companies are depreciating these assets to the P&L account. This concludes my analysis of this video. I would not suggest investing in any of these companies. As far as IL&FS and IVRCL and Jaypee are concerned, these are complete no, because there are many problems with these companies. Even here also, for IRB and IRCON, this also needs to be, we need to wait and understand if these are actually worth investing. Thank you for watching this video.